Our next set, it's not a panel, we're moving into spotlights. Remember that yesterday we had a series of spotlight sessions where we call on experts and thought leaders who come onto the stage, share the podium with us, share some of their work with us, and then of course we open up to all of us to be able to engage with them directly. So we're going to have one spotlight session before we break for lunch. And this spotlight session is really going to be digging into a theme we haven't really touched on, and that's the theme of climate change. Climate change from a payment perspective. And the question that's being addressed is the role of central banks and regulatory authorities in mitigating the impact of climate change. Welcoming him back onto stage to join me is Harish Natarajan. Harish, I'm going to introduce you again in case somebody missed you, but let's give Harish a big round of applause. Harish, of course, is a practice manager in the Financial Inclusion and Infrastructure Finance and Competitiveness and Innovation Division at the World Bank. And our second speaker, Dr. Muhammed Sayed, is going to be joining us online, and so he's going to be coming up on the screen very shortly. Muhammed is a change specialist, in particular in the Climate and Environmental Finance Unit at the Development Bank of Southern Africa, or the DBSA. We're going to lead with Harish, since you're in the room. We're going to then turn to Muhammed as he then shares his insights with us virtually, and then we're going to open up the conversation from there. So Harish, over to you.
Thank you. Good afternoon, everybody. So I'm here to start off with a little bit of background on climate risks in emerging markets and developing economies in particular, looking at a little bit on the response by regulators in emerging markets in particular again, and then zoom into the implications for payment systems and financial market infrastructures. And in this context, it is important to remember that a lot of the discussion so far on climate change and the implications of the financial sector has been largely on the banking and capital markets. Payments and financial market infrastructures has not been that much in focus, but there have been a few examples of that, and I will talk about that. And then I will also talk about how digital financial services can be part of the solution, at least in some part. And then I will conclude with an example from a project at the World Bank where we're trying to bring in some of those different elements. I need to confess that the slides might be a little difficult to see. I did check with the organizers that the slides would be shared, so apologize, I did not expect such a large room. So let me start with a little bit of general framing of the impact of climate change on the economy, and then I'll talk about how it cascades down to the financial sector. So there are two types of risks which are generally talked about. One is the physical risks, which is the impact of climate change in the form of different climate events, which happens on infrastructure, on institutions, on communities and townships and towns and cities and so on. So that's the physical risk, cyclones, typhoons and things like that. And then is the transition risk, and this is about the risks a business and an economy is exposed to as the global economy shifts towards a less carbon or a carbon neutral kind of an economy. That requires a lot of structural adjustments at an economy level as well as at a business level, and that can pose risks. And the risks to the economy come from damage to infrastructure, damage to communities. It could also come from loss, kind of the cost of replacing those infrastructures, and then shift in the economic model that some of the businesses which used to be pretty viable, very profitable, they might suddenly become unviable and unprofitable because of the transition risk and a combination of physical and transition risk. And this then feeds into the financial sector through a higher credit risk, losses banks and financial institutions could be exposed to. Also, the implications which could lead to a kind of insolvency of businesses, more litigation related to that. So there was an example of a litigation generally seen as a first climate change related litigation where a big utility company in California was impacted because of a severe case of forest fire. And that they were implicated in that, but the underlying causes are a combination of climate change, leading to a severe long period of high temperatures, and combined with lack of maintenance on their side, perhaps, which came together, and of course it led to a lot of litigation, and there were a lot of implications because of that to the financial sector. So those are that's the way the impact could cascade. But of course, what happens in the financial sector then feeds back into the economy and then sets off a negative feedback loop. So that is the general framing which is important to keep in mind. Now, looking at the specific case of developing countries or emerging markets and developing economies, what we find based on data is that emerging markets are more vulnerable to climate change than advanced economies. And at the same time, they have less financial resources, and less financial resources being dedicated to address the impacts of climate change. So you're seeing two graphs on the left-hand side. It's basically a graph showing on the one side the likely impact and then the readiness. And what you see is the red dots are advanced economies. They are less exposed and they are more prepared, which is the right place to be, versus versus the emerging markets and developing economies. They have more risk and they're less prepared, which is on the right-hand side in all the blue dots you're seeing. And then from a GDP impact perspective, you have significant impacts across two scenarios of a pessimistic and extreme scenario. And in extreme scenario, there are significant risks going up to over 10% shock to the GDP because of climate change. And then, as I mentioned earlier, the risks are higher, but the climate financing gaps are also higher for the emerging markets. 25% of the global GDP is roughly the composition of the emerging markets, whereas only 14% of the climate financing globally is coming towards emerging market and developing economies. And then 50% of the financing in the developing countries is coming from public sources. And as we all know, there's a significant constraint in terms of the fiscal space. So that is going to pose even more challenge going forward. And another aspect which is not much appreciated is that the focus of much of the climate finance is towards what is basically called mitigation. So in the sense of shifting the economy to more carbon neutral versus adaptation, which is about preparing the businesses, communities, and households to the risks exposed to climate change. And to adaptation, the climate finance is actually only 14% in developing countries, and over 90% of that is coming from public funding. In developing countries, the other characteristic is that much of the financing for the economy comes from the banking sector. Capital markets are not that well developed. Of course, there are many exceptions to that. But in general, capital markets are not that well developed, so there is a very strong dependence on the banking sector for financing the economy and by extension also for climate finance. Whereas 60% of the banks, based on a survey, only 5% of their credit portfolio is towards climate finance. So which basically shows the financing gap is quite significant, and the dependency on the public sector is pretty high for this. And there is also, as we know, that space is, the fiscal space is narrowing to be able to cover the gap. The next one is looking at from a financial institution perspective. And what I'm showing here is a graph which shows that the impact on the capital adequacy ratio of the banks to a sample of banks in a few countries can be pretty significant. And we are talking about capital adequacy ratios coming down by several percentage points in various scenarios. So of course, you could have individual risk events. You could have compound risk events in the sense of impact of two simultaneous or two quickly following events, like the pandemic combined with, say, a climate risk event. And there the risk is even higher. And if you see the preparedness of the financial industry and the financial institutions, a lot of them have talked about strategy and so on, but the real understanding, real work on understanding what are the risks and the plans to address them, there are very, very few. Less than 5%, 10% of the banks are actually prepared for that. Then what I'm showing is a complicated table which summarizes what actions regulators are taking. So there are broadly 4 categories of actions. So one is what is called as micro-prudential kind of requirements. So where basically one of them is the regulator asking the financial industry to prepare transition plans. So this is about asking an institution to think about it, think about climate change, what is the impact on their portfolio, and how will they prepare for it. And then there are other requirements which could be more macroprudential related to the loan to value in terms of giving a higher loan to value for a green mortgage or a green loan. Then there could be directed lending related policies, and there could be central bank tools like giving a better haircut, a more favorable haircut for a green collateral, or a higher reserve requirement if the loan is in a sector which is more exposed to climate change. So there are various series of responses from the regulators in emerging markets. Some of them are a clear case of that it is generally agreed that it will do good. There are a few which are more where the jury is out, and a few which is clearly not a good thing to do based on past experience, like directed lending towards specific industries generally has been seen as not very constructive and not very positive. I think the summary is that I think there are a lot of regulatory policies which are being explored, but I think the central banks and financial regulators should not lose sight that the primary goal is stability, and anything which is being done here should not affect and impact stability negatively. And at the same time, efforts to foster development of climate finance, foster better understanding, and foster better appreciation of the risk management, and providing some tools which could help the industry. Those are all steps in the right direction. And one of them, which has been widely regarded as very important, in particular in mobilizing financing towards climate change, is what is called as taxonomy of what could constitute a green bond, what are the requirements for a bond to be categorized as that, what would be considered as a green loan, for example. So all of that taxonomy is very important to help prepare and guide the industry towards the right investments. And then the other point is that the development of capital markets, development finance institutions like the other speaker, he represents a development finance institution, credit guarantee institutions are going to be very important to crowd in private finance to support the climate finance agenda. Now, specifically now zooming into the payment systems and financial market infrastructures topic. So because of the physical risks, there's a very clear link to the operational risk which payment systems and financial market infrastructures could be exposed to, which could, over a period of time, could also lead to the general business risk in the sense of the business being able to continue as a going concern. And the difference between the traditional operational risk, which I think was talked about quite extensively in the session in the morning, the difference with the climate change related operational risk is that this could be much more persistent. It could be there for a longer time, and it could keep happening, and it could basically call into question your backup and your disaster recovery strategy, because both the sides could be simultaneously affected. It could affect the society entirely. So I think one of the colleagues was talking about 3 staff and them not going in the same plane and so on, but that is very difficult to handle in the case of a climate event where there could be multiple locations in a country affected. So that is the point on operational risk, and of course you could try to insure against that, and over a period of time the insurance might not be possible, though the premiums would be too excessive, and all of this could lead to the business itself being exposed to risk. And then the other one is on the financial risk side. There could be implications for the credit risk exposed to which central counterparties, security settlement systems could be exposed to. There could be implications for the collateral, the margins they collect. All of them could deteriorate in value, which could lead to more margin calls, unpredictable margin calls, which could again cascade. And then these risks could also translate and cascade into the payment systems which are being used to settle some of the financial market transactions. So basically, you have physical risks on the one side, which is more the operational risk domain, and then you have the financial risks, which are coming in because of the implications for the underlying financial markets and the underlying financial assets which are being transacted. And there is an interplay between these. So if there's an operational risk event, it becomes more difficult to deal with some of the credit risk events or an implication of a liquidity crisis when you're also dealing with an operational risk. So there's an interplay between these as well. So what are authorities doing? So here we talked a little bit about payment systems and national payment systems oversight. So oversight is an area which I think could be very relevant to the topic of climate change as well, to where the payment systems overseers or the financial market infrastructure overseers can look at the impact on the system and the ecosystem as a whole and be able to induce change, support the regulators in framing regulations and policies to support the industry to be better prepared. And here, this is at a very early stage. The Dutch Central Bank has been a pioneer in this area. They have put out some best practices, essentially focusing on helping the industry understand the different climate risks they are exposed to, requiring them to think about how to prepare for it, so in a way, some kind of a transition plan, and then also making them think about the carbon footprint of their own infrastructure and all the processes which support the functioning of the FMI. In this regard, there are other institutions like the Depository Trust and Trust, which is essentially the Securities Depository and Securities Settlement Systems for the US capital markets. They have done some work, also some of the regional bodies, and there's an ongoing work in some of the standard setting bodies related to how to think about it. But I think at a general high level, the principles for financial market infrastructures, which was in a way adopted in 2012, which was an immediate direct link to the global financial crisis that was the immediate trigger, that already has language and framing which can very well easily lend into the taxonomy of the climate risks payments and FMIs could be exposed to. And I have left here some wording which you could read with some time. And you will see that the wording is actually very, very pertinent also to this kind of risk. One of the immediate steps which is required, of course, is to understand what is the climate risk your institution is exposed to. And here it is important to have access to good data. And here again, there is a problem in emerging markets where the data for estimating the climate risk is very limited. Only 1 in 5 countries have reliable data. The World Bank is supporting the development of a global hub called the World Bank Climate Change Knowledge Portal, which includes a lot of information related to the rainfall patterns, the weather patterns, the likelihood of a drought in a given part of a country, and so on. All of that could be helpful in estimating the climate risk. And there is also effort towards developing what is called as an ESG data portal. And this provides more accurate information to the global financial institutions as they try to estimate what is the ESG exposure, and that way you are able to get better spreads if you have accurate information. So to address the information gap, there are a couple of initiatives from the World Bank in this regard. Now, I will quickly move to one interesting aspect of all of this discussion, which is about the carbon footprint of payment instruments and systems more generally. And here, there have been some studies done by the Dutch Central Bank, by Bank of England, and by other providers. And the general conclusion is that the per transaction cost and carbon footprint is quite limited. To put a figure for one debit card, which was estimated by the Dutch Central Bank, the exposure is basically equivalent to an 8-watt bulb running for 1.5 hours. And on an overall basis, all the debit card transactions in Netherlands was only 0.006% of the overall carbon footprint. So pretty small, but this is something worth monitoring. Of course, there is also the cost of paper. Paper money is more, than the card transactions, is 1.5 times more, but you're talking about very small numbers here. And then you also need to think about the recyclability, the source materials which are being used. So here, if you look at the POS terminals, they come in at a quadrant where the footprint of the supply chain related to the POS terminals is very high and they cannot be recycled, versus paper and polymer money. They could be recycled, but then there's a very significant distribution cost related to that. And between paper and polymer, polymer is better because it is lasts for longer. And then there's a comparison with cryptocurrencies, and by extension, potentially central bank currencies as well, digital currencies as well. And some studies basically say if the right design is chosen, basically very traditional design is chosen, then the footprint of a retail CBDC would be very similar to a debit card. But if you use a more public blockchain-based design, then you're going to in the direction of a Bitcoin, where a per transaction costs as much as an average household in advanced economy consumes in a month, as much electricity as it consumes in a month. So it can be pretty high when you go in that direction. So then let me move to the digital financial services. And here I'm talking more generally about fintech developments and digital developments and so on. So I see 5 key ways in which digital financial services could support climate change. One is on supporting the resiliency through faster delivery of relief funds from the government and other actors, including friends and families and so on. So here I think fast payments in particular is very important, and we have seen this in various climate events where the payment systems have played a very crucial role, and here any developments, improvements you make to the payment systems would be very relevant. And then the second area is, of course, the consumption of kind of the carbon footprint of households and small businesses is not that big, but it does add up. And here, supporting the adoption of more clean household appliances, small machinery, and so on can go a long way. And this, in fact, is also relevant because sometimes big suppliers are trying to address the carbon footprint of the entire supply chain. So if you, as a small business, you're not using clean equipment, you might be impacted. And here, the digital financial services have a role to provide easy access to credit towards buying and investing in these kind of resources. And the third is support new business models, like pay-as-you-go, to support move towards clean energy sources. There's good examples of that in the case of solar and so on. And then is the market infrastructure for the carbon markets, which is actually underdeveloped currently. There's a lot of them is in the private, kind of over-the-counter kind of an arrangement. So over a period of time, if that market is going to develop, there's going to be infrastructure required for that, and the digital financial services could be very relevant, in particular including all this tokenization-based market infrastructure which are being talked about. And the last one is about parametric insurance, and there's a lot of digital technologies which goes into that, and that could make the delivery of insurance payouts based on weather events very fast. And I'll just conclude with an example where at the World Bank we are bringing this together. So this is the case of what we call, the project is called DRIVE, is basically de-risking kind of vulnerable communities. And this is about pastoral economy in the Horn of Africa, Somalia, Ethiopia, Djibouti, where there's a package of services made available to the pastoralist, which promotes savings, gives them access to a parametric insurance, which pays out when there's a drought, which impacts their cattle, and that way they're able to protect themselves, build more resiliency towards climate change. This project is being replicated in other parts of the world, and there's also a very similar design of project which covers the Southern African Development Community, which supports the resiliency of small businesses which are impacted by climate change. So with this, let me conclude, and thanks to the chair for giving me a few extra minutes.
Absolutely, Harish. A big round of applause. Thank you so very much. Can I invite you to the seat closest to me? And ladies and gentlemen, I can see some tables have already wanting to get into the conversation with you, Harish. But what we'd love to do right now then is to go to Dr. Muhammed Sayed, who's joining us virtually, who also is going to have an opportunity to respond to the question of climate change from a payments perspective and what the role of central banks in this regard may be. So, Dr. Sayed, if you can hear me, it is over to you.
Thank you so much. I just wanted to confirm if you can hear me.
Yes, we can hear you, and we can see your presentation as well. Thank you so much.
All right, thank you so much. There's a bit of an echo on my end.
So there is a little bit of an echo, so our technical team, if we can work on that, and then also if we can, thank you so much for the thumbs up, and if we can also ensure that even as we see Muhammad on the screen, we have visibility of his slides at the same time, please. Thank you for the thumbs up, noted. So Muhammad, over to you.
Can you hear me now?
Yes, you can go ahead. Thank you so much. We're just going to keep trying, ladies and gentlemen. My apologies. Please just do bear with us. We definitely want to hear from Muhammad on this. And so, Muhammad, I can see the team working at the back to ensure that we can hear you and you can hear us. We can hear you. Can you hear me?
Yes, I can. And there's no echo. Hope you can hear me now.
We will survive. It's absolutely not bad. We can definitely handle it. Please go ahead.
No, thank you so much. I'll try and be as brief as possible and just excuse, unfortunately, I have a bit of a bad flu, so I couldn't be there physically, but I'll do my best. So
right.
I'll share
my
some
apologies, Mohammed. If we can just help with the boosting the audio, please, gentlemen. I think we can follow with the echo, but if we can just have him a little bit louder, that would be fantastic. And Mohammed, if we can just double check on your side that your volume is as up as possible. Thank you for the thumbs up. Back to you, Mohammed. Thank you.
No, thank you. I'll try and raise my voice. I've put it on maximum, so hopefully it's a bit better. So I'll just share some perspectives from a development finance institution in terms of what we are doing in terms of addressing climate change as an infrastructure bank. I think most of you are probably aware of DBSA. We are infrastructure bank, predominantly focusing on key economic infrastructure sectors, energy, transport, ICT. We also look at the water sector as well. And our focus is we want to achieve an objective of supporting infrastructure which is sustainable. And by that we mean it can respond to impacts of climate change, but also mitigate the impacts as well. What I'll try and also do in this presentation is towards the end just share some perspectives in terms of what we believe could be the possible role of central banks, noting that the mandates may vary from different countries, and trying to balance economic imperatives with climate objectives can be a bit tricky. But I'll just share some perspectives. But I think Harish did a fantastic job in terms of sharing what other central banks are doing in this space. My presentation is broader than just focusing on payments, but just looking at the financial system and financial institutions in terms of how we approach climate finance, some of the challenges we are facing in the space, and how we're trying to address those challenges. So I think the first thing to highlight, and I think Harish mentioned this in his presentation, is that it's quite clear that to address the climate challenge, it's important that we mobilize private sector funding. Public sources are simply not sufficient. And in order for us to support countries in meeting their commitments to the Paris Agreement, what we refer to as the nationally determined contributions, or NDCs, it's important that everyone plays a role, including financial institutions, as well as central banks, of course. And the idea is, from our perspective as a DFI, is to see how we can mobilize commercial funding as well in the space that we operate in, which is infrastructure finance. And here we're looking at ways of mitigating climate impacts by looking at renewable energy projects, green transport. But from a climate adaptation perspective, as Harish mentioned, we're not seeing as many projects, but from our perspective as an infrastructure bank, we do believe, we can make significant contributions towards climate adaptation, specifically in the water sector. And I'll just mention a very brief example in that regard. However, the key issue or the key challenge we face in terms of mobilizing private sector finance for climate change is, of course, some of the key barriers that they face. They still consider, this sector to be quite, quite risky, depending obviously on the specific areas. Renewable energy, as you may be aware, it's a lot more mature compared to other to other green sectors. So, the risk will vary, but clearly what we are seeing is that there are a combination of factors which impact private sector involvement in addressing climate change. A part of it is, of course, regulatory issues where the regulations may not be very clear. For example, in the case of, green transport, I think in South Africa, we are seeing very positive regulatory measures around the rolling out of renewable energy, especially around embedded generation. But previously, that was hampering private sector involvement as well as project developers developing projects in that space. I think what's quite key as well is ensuring that you have the right enabling environment to support, the transition towards a greener economy, and financial institutions are obviously, quite key as well in terms of ensuring that we do have the right environment. And last but not least, political will and uncertainty can also play a role, where you may find in certain countries, there might be vested interests around, a fossil fuel-based economy. So you might find, you might not have a very strong political will in terms of supporting that transition. So that also varies from country to country. However, as a development bank and as a national development bank with a regional geographical kind of focus, we believe, we can play an important role in terms of addressing some of these challenges and difficulties, especially in terms of ensuring that we have projects which are bankable, but also, as you will see later, designing financing instruments to de-risk projects in order to crowd in private sector. And I'll mention just one or two examples in terms of our approach in this regard. So as a DFI and as a National Development Bank, one area that we've been focusing on to address climate change in the infrastructure space is by seeking accreditation with global climate finance mechanisms, and in particular, your United Nations climate change financing frameworks, your Green Climate Fund, which is, I think a lot of you might have heard of. It's by far the largest, climate fund, and a lot of financial institutions are accredited with the GCF, including, multilateral development banks and national development banks, as well as commercial banks as well. And we believe that, national development banks, through accreditation with these mechanisms, can play an important role to facilitate climate investments and hopefully deliver such finance to, to project developers and beneficiaries. So we do believe we can play an important role through our relationship with not only project sponsors, the project developers, but also our relationship with commercial banks. Harish touched upon some of the risk associated with not addressing climate change. And I think for financial institutions, the risk varies. And I think if you had to discuss this topic maybe 10 years ago, a lot of institutions, might still be at a very early stage of trying to embed climate change in their strategic priorities. But I think things have moved on quite significantly over the last few years. My view is that it's no longer, a good to have. It's actually a must, and it's just a question of how fast institutions can embed climate change and embed climate risk in their operations. So I don't think it's no longer a question of, should it be done, but a question of how quick can we do it. And, the risk, as we've mentioned before, varies from the financial risk with, in terms of, having assets that are still fossil fuel based, and you might have stranded assets in that regard. Harish spoke about, obviously, the various transition and physical risk in relation to supporting infrastructure, which may not be resilient to the impacts of extreme weather events. And we've already seen that happening, for example, in KwaZulu-Natal with the recent floods in recent years. I think one aspect that we've seen coming to the fore at your climate talks, the COP meetings, it's issues around greenwashing. And for financial institutions, it's important to ensure that you have transparency and you use the right taxonomy to classify projects. And I think this was raised as well in the previous talk. Otherwise, there is a risk of greenwashing. And what I can mention is, there is a lot of scrutiny from NGOs on financial institutions and other entities to ensure there is proper reporting of green or climate-related investments, or what institutions classify as climate-related investments. So what is required is, of course, in order to mitigate this risk, is ensuring that you have, embedding climate risk assessments in your operations, have clear targets which are science-based, and we are seeing institutions doing that. Of course, what is quite key is disclosing such information in the public domain. So again, that's something that we are seeing a lot of financial institutions starting to do based on their volunteering or being part of the Task Force for Climate-Related Disclosures, the TCFD. Apologies for that. And more recently, nature-based disclosures. As I mentioned before, I think climate is now a given. And what we are seeing now is a nature-based investments also coming to the fore. But I think that will take some time. So ultimately, institutions need to start looking at these mitigation measures. So just very briefly, in terms of what the DBSA has done to date is, firstly, we've tried to have dedicated facilities or programs that are developed specifically with the primary objective to achieve climate mitigation or climate adaptation objectives. And we do so by mobilizing concessional finance from global climate funds such as the Green Climate Facility. Even though accessing these funds, it's not easy. It does come with its own challenges, and I'll touch upon some of those challenges. And I believe central banks can hopefully assist financial institutions and accredited entities to better access these funds. From a policy perspective, as I've mentioned before, it's important for institutions to start, having policies which are aligned to global agreements. We've mentioned the importance of ensuring that you start exploring tools around climate risk in your own operations and your own environment. And we are doing that currently within DBSA. We're not there yet, but I think it's an exercise which a lot of development finance institutions are busy undertaking. Some are more advanced than others. And beyond climate, even biodiversity risk is being explored in the infrastructure space. So from a funding perspective, from a policy perspective, and then from alignment to global agreements, I think it's a multi-pronged approach that we are trying to look at. Currently, we are trying to align ourselves with other development finance institutions through our membership with the International Development Finance Club, but also through taxonomies that are developed, with other members, and South Africa's own green taxonomy, but also through the work that we are doing through what we report as part of the Task Force for Climate-Related Disclosures, TCFD, which I think a lot of commercial banks are also reporting on. I don't want to dwell much into how financial institutions can mobilize climate finance. But I think it's important just to mention very briefly the role of the Green Climate Fund, which, as I mentioned before, is quite a huge facility that is made available for developing countries, specifically looking at both climate adaptation and mitigation measures. They're supporting low emission and climate resilient pathways. And the way of accessing these funds has to be through what they call accredited entities. And there's quite a long process to get accredited. And to date, there are a number of multilateral development banks as well as national development banks like ourselves as DBSA or regional development banks that are accredited. We are accredited to cover the Southern African region, although we can go beyond as well. And our approach with GCF is to design programs and facilities that talk to key economic infrastructure, whether it's in the energy space, the transport sector, and more recently, we've designed a program to support municipalities in South Africa around water reuse, which is predominantly a climate adaptation intervention to address issues around water scarcity in response to droughts, even though you could have water reuse being a climate adaptation intervention, even in response to flooding as well. But I think the point to mention here, I guess, is that these funds are not easy to access. It does come with its own challenges. The funding is predominantly in hard currency, in dollars. And in South Africa, there are regulations where, we can't, provide loans in USD to South African entities. So what it means is that we have to hedge those funds, and the hedging cost sometimes, diminishes the concessionality that you get from these large global funds. So I think that's an area perhaps that maybe the central bank can look into. But I think if we can find a way of having a robust system that allows, inflows and outflows, through these global climate finance mechanisms, and where the central banks can perhaps assist in this regard, would be quite useful. I don't think I have a lot of time left. I'm not going to dwell into some of the programs we've developed with these global climate mechanisms. Suffice to note that what we've done is design programs to crowd in private sector to bring in commercial bank funding. And we do this by providing credit enhancement using the concessional finance from these large global funds, blend it with our own resources, and using senior debt from commercial funders to then support renewable energy projects, energy efficiency projects, green transport, water efficiency initiatives, dedicated programs around solar PV and wind, as you'll see here with the embedded generation investment program, where once again regulations are quite key. We've seen obviously the regulations around embedded generation evolve over the last few years, and we had to adapt these programs to those regulations. So I think that's an area again where we believe central banks can hopefully also play a key role. And maybe just one program to mention around adaptation, which is water reuse. This was the largest investment by the GCF globally on a climate adaptation project, which was approved last year. It's a program specifically focusing on supporting water reuse infrastructure in South Africa by once again crowding in private sector capital, by looking at the water sector, by creating a new asset class in the space. So I think this is quite a key program we are quite excited about because it talks more towards adaptation, although mitigation is kind of the low-hanging fruit. My last slide just talks a bit about some of the areas where we believe, central banks could play a role. Harish, did a fantastic job, discussing some of that. So I won't spend too much time. But just to note that, based on forums that we've, shared with central banks around climate change matters and issues, we've seen certain central banks playing quite a key role. Obviously, from a monetary policy perspective, where climate risk pricing is being looked at, also advising on specialized instruments that could be used, including green bonds in specific countries. Of course, the issue of ensuring financial stability is quite key, and we have seen examples of central banks, I know in England, for example, doing stress tests and evaluating the ability of financial institutions to be resilient to the impact of climate-related shocks. And then, of course, I already mentioned from a regulatory perspective, offering guidance to the financial institutions around, how best to do climate risk assessments, or I'm not suggesting enforcing such assessments, but I think at the moment, a lot of this is done on a voluntary basis. But perhaps at some point, there has to be a consistent way of ensuring that these assessments are done. There's a standardized approach of undertaking these climate risk assessments. And then last but not least, I believe, central banks, could play quite a key role in terms of just, undertaking key research in the space around, the economic impacts of climate change, and how central banks, perhaps in collaboration with other banks around the world, could ensure that we can share best practices with regards to climate risk management strategies. So I think I spoke a lot, but I'll leave it at that, and hopefully hand over to the floor. I hope I was audible,
Yes.
and you at least got the gist of what I was trying to say. Thank you.
Thank you so much, Muhammad. You were more than audible, very clear. Thank you very much for that contribution. What we're going to do now is that we're going to open up the conversation to the floor. I already have table 8 standing by to ask a question or to make a comment. We've got about 10 minutes, so I would really encourage 2 or 3 others to get into the conversation. So let me start off with table 8. I think we're with you, Zinhle. Over to you.
Thank you, Mashabalal. Climate change for me personally is always quite difficult to understand, but there's some knowledge there, and it's quite interesting because it's one of the engagements that I have had in my line of work. But I think just to the 2 gentlemen, in lay terms, my question is, looking at payments and data as well, how vulnerable are our data centers, as well as the critical payment services, to the increased risks associated with climate change? And then just further to that, how much pressure are banks in particular under in order to ensure that there is continuous operation within the financial sector?
Thank you very much, Zinhle. I'm making my way now to table 56.
Okay, I just want to say thank you so much for the insightful presentations. And I think the exposure, the climate exposure for financial institutions and their potential financial instability was quite clear. But I think that what wasn't so clear was how African central banks can green their own payment operations in economies with limited resources, data, infrastructure, and also with a larger informal sector, making digitalization much more difficult. So here, we'd really like to hear about how to decrease our Scope 2, Scope 3 emissions in data centers. The Bank of England, for example, they recently switched to polymer banknotes, and how we can collaborate better to have early warning systems between regional central banks.
Thank you very much. Early warning systems as a final point. I did miss your name. My apologies.
Sorry, it's because I didn't give it. Shantesa Ragavelu from the SARB.
Shantesa, thank you very much. Do I have another? I'm doing a quick scan, and I'm not seeing another table popping up. So those are the 2. And Mohammed, I'd love to make sure that you are integrated into this conversation as well. But Harish, let's start off in the room, because data centers have come up in both of the questions that have been raised. But Zinhle is asking, how vulnerable are data centers to some of the climate change risks, especially when we think about how critical they are in terms of the resilience of payment systems?
Yes, I know. I think this is a very important important question, and this is also being discussed quite extensively. There have been instances rather, where data centers have been impacted because of climate events. I had a few examples in my slide. One of them was an Amazon data center was significantly impacted. So it's very clear, the data centers are exposed. The specific case of South Africa and the region, I'm not familiar enough, but clearly I think the climate change and the climate risk related physical risk needs to be factored into the operational risk strategy, operational risk management plans. And I think as the discussion earlier today was showing, that is an area which requires a lot of attention. And then I think the complexity increases when you also factor in the climate risk aspect. So I think that's where I would leave it. But I think the other point related to, there is also a discussion about greening the data centers, in the sense the data centers are, of course, huge consumers of energy, in particular because of artificial intelligence now. There's a lot of effort towards setting up more data centers. And because the climate, because of the carbon footprint is so high, there's an effort to go towards more renewable sources of energy. Many of you would have read the recent news article about Microsoft trying to buy or trying to get into an agreement to use a decommissioned nuclear plant for its data center. That goes to show the kind of effort which is going in. And this is also coming in from the effort of many of the corporates as part of their ESG commitment. They want to have a carbon neutral footprint, and companies which cannot mitigate, which cannot avoid the consumption of electricity and so on, so they are going towards more clean sources, and one of them is the data center industry.
Yeah, and thank you for going there as well, because you've also spoken to the second question from Shantessa, which was, how do we think about decreasing emissions from data centers? And what I'm hearing you say is there is some evolution in terms of going green in that regard. But Mohammed, I want to bring the second part of Zinhle's question to you, because I think largely it is an infrastructure related question, which is saying, how much pressure are we under in terms of the risk of continuous operations? So when you think about the infrastructure that keeps not only the payment system alive, but that keeps financial services alive, that must be an important consideration as you're thinking about the infrastructure landscape that enables economies to function. And do you see an association between that infrastructure and climate events?
Absolutely, and I think basically what's required is doing a vulnerability assessment to understand, what are the key risks, associated with the particular infrastructure in terms of various climate change events, be it extreme weather events. I just wanted to confirm if I am still audible.
Very clear.
All right, okay. So I think what we are doing currently at the moment, and I think it touches on the question around early warning systems, there is an initiative that we are doing with the SADC Secretariat and the Global Water Partnership around early warning systems for the SADC region. And the idea there is to assess the extent to which infrastructure in the SADC region, could be exposed to extreme weather events. We've seen impacts of Hurricane Idai, in Mozambique and Zimbabwe, etc., on key infrastructure. So that type of analysis is quite important. And I think in the context of, what we're talking about in this conference, a similar analysis may be required in terms of the exposure of data centers, as an example, in terms of the locations of these data centers. And to what extent, flood risk, could be quite a key challenge. And then the question is, once you understand the risk, how do you ensure that these centers are resilient? And this is where the funding becomes quite key. Are there innovative approaches to ensure that, you can address and improve the resilience and climate-proof this type of infrastructure? And I think this is where the funding of such interventions would be quite key, and this is where these dedicated green facilities, whether it's climate finance facilities or green funds, can play quite a key role. So we can actually fund the climate proofing of these centers and infrastructure through the dedicated mechanisms that we've put in place to date. So I think that's another area where we believe, we could support, where these challenges have been identified through these concessional finance, and in some cases, even grant funding as well can be made available.
Yeah, Muhammed, thank you very much. And I want to bring Harish just a final comment on the basis of what Harish just shared on early warning systems and mechanisms. And that is, what is the appetite for leveraging financing instruments, or for financing in general, for early warning mechanisms? Are you finding that it's easier to crowd in funding if it's going to build in that resilience and build in an early warning system?
Yeah, and on early warning systems, of course, require a lot of investment.
Sure.
From the perspective of, you need, of course, models to predict what's going to happen. You need a lot of weather stations to be set up. Then, of course, the institutional arrangements around it. And then it is also needs to be part of national and regional disaster recovery planning, disaster planning, as sometimes it is called. So all of that does require quite a bit of financing, as well as strong commitment and political will. There have been a lot of efforts in this area, and a lot of countries have invested in that. And there is concessional financing and multilateral financing available for that. So it is largely an area where the public sector financing has been focused on.
Yeah.
And of course, once that is there in place, of course, the benefit is for the entire country and entire economy. So this is a worthwhile public investment.
I think it's a beautiful place for us to wrap up the conversation with 19 seconds to go on the clock. Muhammed, thank you very much for your participation. And of course, thank you to you as well, Harish. And to the both gentlemen, ladies and gentlemen, just to remind you that their presentations will be uploaded onto the conference app. Remember, the QR code on your badge is the QR code on top. So if you go into that QR code, give us about an hour or so, you will be able to access both presentations. Thank you so much.